Hi, welcome back to our 2025 mentorship series, our bootcamp, lecture 5. So today we are going to be looking at fair value gaps. As you know, we are looking at liquidity itself, and we looked at internal range liquidity and external range liquidity. So for internal range liquidity, we looked at the PDRS, we looked at the criteria behind them, and so we said we are going to be looking at each type separately. So we have fair value gaps. So fair value gaps, this is a simple concept, and with its simplicity comes a great role that it plays in our trading. So a fair value gap is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame. So price can actually gap in the market. So what do I mean by this? So a fair value gap, most people explain it as a 3-candle pattern, but it's not a pattern. It's a range in the price delivery. As I told you, we are going to be looking at pure price action on our YouTube channel. So we are going to be looking at everything with a reason. We're not going to be talking about something we don't know about. So a fair value gap is not a pattern. It is a range in price delivery. So as you know, ranges. So fair value gaps are inside the range, and we are venturing further into trading in the range. So for a fair value gap to form, we need market to gap down, because typically, on default, what the market has to be doing, market has to be balancing between buy orders and sell orders within the market. You understand? So market does not have to be leaving orders unfulfilled. But what happens in the market, what happens in the fair value gap? The fair value gap only happens when there is only price delivery to one side of the market. So I need 3 candles to make this formation of the fair value gap. So I need the first candle. So take an example of the bearish setup of the fair value gap. I need the first candle, I need the second candle, and the third candle. So where does the fair value gap form? We have the low of this first candle coming in at this, and then we also have the high of the third candle coming in at this. By default, as it had to be before, these candles had to be in such a formation where this first candle closes and the second candle goes lower and closes. Then the third candle comes back and reprices into these orders to fulfill them. So what happens in the fair value gap? In this scenario, the third candle will not come back to fulfill the orders that are in the fair value gap, that are in this fair value gap. So this makes this gap have unfulfilled orders. So take an example. If we are looking at candle per candle, with each candle that makes up the fair value gap, so we are having this first candle. If we are to look at how this candle moved, this is the open, because this is a bearish candle. This is the open of the candle. The candle opens up and goes back up. So this is buy side delivery. There is a difference between buy side liquidity and buy side delivery. So market delivered, taking in buy side orders, going up, then drops down, and then reaches a price point, and then delivers buy side again till it closes. So this move from the bottom of this candle to the close of that candle, that is this move shows let me see, how should I mark this? This move shows delivery of the market to buy side. So we have the second candle and we have the third candle. If we are to look at the third candle, what the third candle did, we have the candle opening up, delivering buy side, then dropping lower, and also delivering buy side to close. So we also have a third candle that has delivered buy side. So in this price point, this certain price, this range, market only delivered buy side. We have not seen any sell side delivery within this. So in this price projection, where do we have an area that market did not deliver anything into it? Where do we have fresh orders that were not tapped in or fulfilled? That would leave us with an area between this low and the high of this candle. So from this low to the high of this candle, that is what we call the fair value gap. So this would basically be a bearish fair value gap, like bearish fair value gap. So this fair value gap forms when we have price delivering in only one direction. So this is an overall bearish price delivery. So we do not have market delivering, but we do not have market delivering sell side within this price range. We are only delivering buy side. That means sell side orders are left unfulfilled. And what happens, because those orders are left unfulfilled, the market will want to reprice to this price point to fulfill these orders, then continue lower. So that's basically the criteria behind fair value gaps. Now that was a bearish fair value gap. Now if we are to look at a bullish fair value gap, we have the first candle, the second candle, and the third candle. So on our first candle, we see market dropping lower, delivering sell side, then going higher and delivering sell side again to close. So this, from that to that, that is sell side delivery. And if we are to look at the third candle that forms our fair value gap, we also have market delivering sell side and then going higher. So we have sell side delivery again. Now what does that mean? That means market has left us with a region without buy side delivery. So we are having only sell side delivery within this price range, and that leaves a fair value gap, an area where market has not delivered or where market has unfulfilled orders. So in this scenario, we are going to be having unfulfilled buy orders. What will the market want to do? The market will want to drop lower and fulfill these buy orders before continuing higher. That means the orders that were in this fair value gap will sponsor the move that comes from it going higher to the intended extremity. I hope you get me. So for a bullish fair value gap will be marked from the high of the first candle to the low of the third candle. So that is our bullish fair value gap. The fair value gap is such a simple concept and is also such a crucial concept. Now we have some tricky scenarios where we have what we call volume imbalances. So volume imbalances are also gaps in the market, but these are left when price jumps or when price delivers in a certain direction with such high volume and intends to leave gaps in the market that do not have price action within them. So if suppose I have this first candle and the closure where this first candle closes is where the second candle has to open, as you see how I was drawing them. So I'm having the closure of this candle, then the open of that candle at where this closed. I'm also having the same here. Now what happens if market is when market has a large sell side delivery volume and it just skips certain price points, that means we are going to have still unfulfilled orders within that. And with this scenario, we are going to draw if this volume imbalance, I'm not going to be explaining a volume imbalance again, from this candle's closure to this candle's open, if we have price jumping from this price point and not opening the next candle at that price point and opening it at a lower price point, that gives us a volume imbalance. And in this volume imbalance, we are also having a cluster of orders that were not fulfilled because market just skipped. That means if the second candle and the third candle intend to give us a fair value gap, or if we continue with this steady momentum and price just goes lower and lower, leaving a fair value gap, we shall not annotate our fair value gap, or we shall not delineate our fair value gap from the low. We shall be marking it from the close, taking in this volume imbalance to the open. So if we also have a volume imbalance right here, we shall take our fair value gap to where the volume imbalance also ends. So that is it. Same to buy side. If we have a volume imbalance right there and a volume imbalance may be right there, it doesn't have to be on both candles, it can be on one, like that. Then we have to take our fair value gap from the low of the third candle to the close of the first candle. But all in all, a gap in price that leaves certain price points without price action is a volume imbalance. So if I'm to have from the close of that candle to the open of this other candle, that gives me my volume imbalance. So same applies to this. Same applies to the bearish example. That gives me my volume imbalance. But as I told you, volume imbalances have room for error. So we shall study on how we shall be looking on how market has to react to different fair value gaps. Now, for this fair value gap, a bearish fair value gap, we said this bearish fair value gap lacks sell side delivery. That means when market comes back to this bearish fair value gap, it is going to deliver bearish price action. So if market happens to come back higher and tap into this bearish fair value gap, and in this case scenario we are having a volume imbalance to it. So if market comes, so our fair value gap starts from the volume imbalance going higher to also covering this volume imbalance. If the market comes from where it is, from its current price, and moves back into our fair value gap, we expect this fair value gap to deliver bearish price action, to push price lower, in simple terms. Now that's the criteria, that's the default on how it has to work. Then we also have the bullish fair value gap. In the bullish fair value gap, we said we have only sell side delivery. That means we expect this bullish fair value gap to push price higher, giving us buy side delivery, something of that sort. So that is the default. Now in areas where we have the market disrespecting this original of how these fair value gaps have to work. Now what happens when the market does not respect this and drops lower, continuing without respecting the fair value gap? That gives us an inversion fair value gap. So the first by default, these fair value gaps had to deliver, the bullish fair value gap had to deliver bullish price action. But if it is disrespected, then its role will be inversed. Its role will change from delivering bullish price action to giving us bearish price action. That's where we get an inversion fair value gap. So that will be the case scenario of the inversion fair value gap, and I would be marking it as the inversion fair value gap, just like that. So if the market does not respect the bullish fair value gap and drops lower, But this happens with one condition: the market has to give us a body closure below the fair value gap that we are to call disrespected. We can have the market dropping and going furthermore, as long as it does not close below. If it closes below, then that is an inversion. If it does not close below but pass through it, that's what we call a mohawk, and that is acceptable for these PDRs. Same applies to the bearish fair value gap. We expect market to drop from it, but if it's surpassed and the market gives us a candle closure above it, that means it's an inversion fair value gap, and its role has been switched from giving us bearish price action to giving us bullish price action. So something of that sort. I'll have my inversion fair value gap. And then we also have, I'm giving you different types of fair value gaps. I don't want to be going again and again to save time. We have what we call a reclaimed fair value gap. Now, if this fair value gap is retested again, that gives us a reclaimed fair value gap. If market comes back and reclaims the whole of that fair value gap and uses it for another time, it gives us a reclaimed fair value gap. So basically that is it about fair value gaps. What we need, like the criteria about the fair value gaps, what we need are mostly chart examples on how to use this. Now, this is one scenario on how I use the fair value gap. This was Friday. This was last Friday. Let me remove this, and also this. Those are advanced concepts. Now, in this case scenario, if I'm to put off whatever I had drawn on the chart, I'm having this price action. I'm having a range from this high to this low. Market comes back inside the range and drops lower, delivering only bearish price action. I'm having this first candle, the second candle, and the third candle. Leave alone this. So I'm having 3 candles here where the market did not provide enough bearish price action within this, leaving a fair value gap from the low of this candle to the high of this candle. Then what does market use this for? The market comes back into the fair value gap, picks up orders, fulfills orders, reprices into this, and then drops lower. This fair value gap sponsors the whole of this move to the drop lower, chasing what? External range liquidity. So we move from internal range liquidity to external range liquidity, and vice versa. If we are coming from external range liquidity, the market will look for internal range liquidity. So we are inside of the range, and we are, if I'm to draw from this low, from this high to this low, sorry, the annotations are too many, but you have to deal with that. If I'm to draw from that high to that low, you can see we are above 0.5%. That means we are eligible to take sell orders, sell trades. We are above fair pricing. We are in premium. That means the price of this market is in premium. So this fair value gap is a bearish fair value gap. If I'm to annotate it from this candle's low to this candle's high, that is a bearish fair value gap, and the market reprices into this and drops lower. But what I would want you to turn your eye to is, to what point does the market retrace into our fair value gap? Now, for these fair value gaps, we have, as we do the premium and discount, we have where they are strongest. So a bearish fair value gap is strongest below 50%. It's strongest in its discount, and a bullish fair value gap is strongest in its premium. That's why you happen to see price repricing into this, but not going further this way high. Now this is a fair value gap that had a lot of clustered orders that did not allow the market makers to have a move that exhausts orders in the upper portion of this fair value gap. Now we happen to see that violated here. We have from the low of this to the high of this, leaving a fair value gap. Market comes back and gives us a mohawk at first, then goes back higher and closes above it, then reclaims it, uses it again. The orders that were injected to sponsor this move that moved higher were far enough to surpass the orders that were in this fair value gap, but they were not accepted to go higher. We shall look at further concepts of the order blocks. That's why this fair value gap failed at first, but market still kept on going lower because there was another PDRE that supported the move lower. So that is an example of a bearish fair value gap. That's how you can equivocate a bearish fair value gap with your trading. So we shall be looking at it more. We shall be using it more when we are trading live. Now I need a bearish fair value gap, a bullish fair value gap example. It's right here. We have a consolidating market. Market does not go anywhere. We have market taking out. We are inside the range. Market comes back into this bearish fair value gap right here, taking out sufficient liquidity, buy side liquidity here, and then we have a drop lower to take out this sell side liquidity. Then market goes higher, comes back lower, reclaiming this fair value gap that was already used, plus the volume imbalance. So now this is a volume imbalance as shown in the market. We have that is a volume imbalance. That's our volume imbalance, and then we also have the fair value gap right there. From this candle's high to that candle's low, and that is our reclaimed fair value gap. Market has used it for another time after using it again. There is nothing as if a market chooses a PDRE, it cannot come back and use it again. PDRE still work even in 5 years time. So we have this candle's high and this candle's low plus the volume imbalance. So I can just consider this as one. I wanted to show you the volume imbalance itself. If I'm to draw, I will draw from the open of that candle to the low, the high of that candle. But what I want you to look at is how market respects this fair value gap. It was already used. Markets came and took out this liquidity, dropped furthermore into this week. We shall look at that when we are looking at order blocks most of the weeks. Market drops into this week, but fails to close below this fair value gap. That means it did not inverse this fair value gap. It stayed with its purpose of pushing price higher. Now it pushes price higher with such momentum, leaving another fair value gap. Now this, from this high to this candle's low, we have that as our bullish fair value gap. And this bullish fair value gap sponsors a move that takes out this fair value gap that market reacted from here, pushing it lower. This fair value gap sponsors a move that takes out this fair value gap, making it an inversion fair value gap. But when does it become an inversion fair value gap? When the market closes above it. Now we have this candle repricing into this fair value gap, leaving it with its bearish row. Then we have our market trading into this and failing to close above it, and it gives us bearish price action again, this drop with this black candle. Then we have the market going higher and closing above. That means this has turned into an inversion fair value gap, just like that. So we expect its row to be inversed and taken into, it was a bearish fair value gap before, now we expect it to push price higher now, and that's what it did. Market drops lower. Before, its strongest point was below this was its strongest point, and you see it continues to push market lower and lower. But when the strongest point is broken, we happen to have market reverse its strongest point to this upper part, because it has changed into a bullish fair value gap right now. It's an inversion. It drops lower into this, remaining in the upper portion, then continuing higher like that for higher extremities, you see. Now, to show you that these PDRs remain working, I have this market that comes back, reprices again into this and pushes price higher. Now, if I'm to stretch here, market drops into this, staying with its role had reversed. It's an inversion fair value gap. Now it has to push price higher. It pushes price higher, but its strength has reduced and it manages to be closed below. After this candle closes below, market reprices into the lower portion of this inversion fair value gap, because now it's the strongest part of it, and manages to drop lower into this lower price action from that inversion fair value gap. So basically that is it. Those are the types of the fair value gaps we are having. Mostly the inversion, you have to be looking at the inversion at most. You have to look at the bearish and bullish fair value gaps. Then you have to look more into the volume imbalances. I don't want to be executing all trades without you guys knowing about why I executed. Then we also have the reclaimed fair value gaps. So those are the ones I mainly use. I hope this lecture was useful to you. I wish to continue with this journey. May Allah bless us. Thank you. Have a blessed night to you all.